This is Advanced Projections November 2021 Monthly Economic Report. This time we're going to be looking at the following highlights as well as our standard indicators. First of all, the Delta infection and fatality rates dropped noticeably during October as predicted. Infrastructure spending packages that remained stalled in Congress finally passed the first $1.2 trillion portion this past week. New employment gains weakened considerably in August and September, then came back with upgrades along with a strong October jobs report. Unemployment drops to 4.6% due to a surprise labor force contraction, dropping to a level that has already changed the rhetoric of the Federal Reserve. The Fed now plans a well-scripted tapering of asset purchases through mid-2022. Equities markets initially declined further at the beginning of October, then reversed, climbing to new all-time highs. So it's been about 4 weeks since our October 2021 report. The Delta variant of the COVID virus spread rapidly within the unvaccinated population of the USA, but appears to have burned through most of that population. Daily cases and fatalities decline moderately and appear set to continue lower in November before holiday gatherings begin. As we have spent a considerable amount of space on this topic over the past 18 months, our coverage will be reduced somewhat this month to a more limited set of statistics. We are now again around 75,000 new cases per day in the USA, with a small move below 1,400 daily fatalities. These two rates have bumped up a bit from mid-October lows, probably associated with a retreat to more indoor activities and gatherings associated with the beginning of autumn weather and, of course, Halloween. We hope to see a renewed decline in the weeks ahead, along with a stronger move towards getting at least 70% of all Americans fully vaccinated by the time we are solidly into the holiday season. The large $3.5 trillion multi-year infrastructure restoration and improvement package, which had been negotiated in a bipartisan manner, and the $1.2 trillion portion for which we expected passage by the full Congress at the end of September, was stalled within the congressional political quagmire for all of October. Happily, it broke loose and was passed in the first week of this month and was signed by the president. For the time being, the debt ceiling issue has been put on the back burner as Congress kicked this can down the road for just 2 months. It appears that it will be less visible for about 30 days more and then pop up again ahead of a new December deadline. Artificially high year-over-year consumer price index comparisons and supply chain issues have continued to plague many aspects of the economy, keeping prices and inflation expectations elevated as demands remain above available supplies in many areas. CPI figures confirm the onset of inflation during the second quarter, with the CPI up just a little less than 2% in 3 months, and 5.4% in the year since the economic bottom last summer. At the end of the year, we're going to be looking for probably in the 6 to 6.2% total inflation in that CPI number. The Federal Reserve continues to claim we will see only a temporary step up of the inflation rate, lasting perhaps 1 year or so. This does not mean that most of the resulting price increases will come back down, however. The most volatile ones, food and energy, should eventually return to pre-pandemic levels as supplies are restored to normal levels, with energy prices being the later ones to come back down. At this point, again, year-over-year inflation appears to be set for an overall 6% or so bump for the year. Current initial inflation numbers, along with the strengthening employment numbers, have induced the Fed to first change their rhetoric, then their actual policies. Unemployment took another dip down to 4.6% by the end of October. Throughout the middle of 2021, we have said there was no visible event on the horizon that would pierce the bubbles in the equities markets, but that great caution was still warranted in taking personally huge positions in markets which are outrageously risky from valuation standpoints. The Fed, the Treasury, and the popular financial press have continued to discuss how and when the Fed will begin lifting short-term interest rates above the current near zero numbers. With unemployment already dropping below our guideline 5% trigger level for a change in Fed rhetoric. Now it is at 4.6%, and just as we predicted, the Fed announced a gradual end to its asset purchases over the course of the next 8 months, going from $120 billion per month to zero in reduction steps of $15 billion per month. Back in 2018, we wrote to the Fed suggesting that they script their plans for the markets such that people could plan better on how to deal with a changing interest rate and money supply environment. So we couldn't be happier now that they have done just that. We suggested a 2-year script, but we'll take the script they have provided through the end of 2022 as a very positive sign. This helps remove a lot of risk and uncertainty from the economic environment. Third quarter earnings reports have come in ahead of expectations with decent year-to-year comparisons against a dismal third quarter in 2020. However, looking forward to 2022, the picture being painted by companies so far looking forward isn't terribly rosy. Earnings increases in 2022 year over year are painted in the single-digit percentages with almost no growth in revenues. Supply chain bottlenecks and labor shortages are indicated as the major factors limiting growth. Now here are the current underlying socioeconomic details. First, again, the pandemic. Total U.S. fatalities have today reached over 760,000, up approximately 45,000 just in the past month. It appears our projection of nearly 800,000 by December 1st will still be very close, but perhaps more optimistically a little closer to 790,000, and then 810,000 by year end. We base this upon 3 factors. First, vaccination totals continue to improve, reaching teens and those down to age 5. Booster shots for those over 65 are already in wide distribution. There is a link to the CDC for data which backs up this particular point. We have an expectation of significantly reduced threats from any new variants. And third, there are now a few antiviral treatments which are entering mainstream medical acceptance and availability to treat those who have been unable to avoid serious infection for whatever reason. At the onset of July, the major accomplishment had been to reduce the daily fatality numbers down below 400 per day, entering an area of societal tolerance. Now, within early November, still with 9.2 million active cases, essentially existing just amongst the unvaccinated, we are finally likely to see fatalities moving below 1,000 per day again by the end of November. This improving situation and the efforts being made to control it still remains a potential significant challenge to the economic recovery, but it is much more encouraging than just 2 months ago. It is encouraging also to see that the pharmaceutical planners and developers are thinking ahead and anticipating problems rather than being months behind and having to react in a renewed emergency. Legitimate, simpler, pill form treatments are now becoming available for those who have been unable or unwilling to avoid COVID infection. The graphic model that we've been using since it was created a year ago is shown below. Of course, this is in the written report. We modify it monthly to illustrate the still real danger in letting the pandemic continue its havoc here in the United States. At the beginning of March, we were still running above the original late 2020 projections in terms of actual fatalities versus the model. So we were waiting to see for another couple of months if the problem was truly being solved by the first vaccine rollouts. By mid-2021, that was demonstrated by an actual flattening of the curve and moving the fatalities below the model's curve. That was confirmed in our July report. In August, we had to temper our optimism, and we adjusted our predictive model to incorporate the expected effects of the Delta variant, which are shown in orange boundaries on the right half of that chart that I just referenced. Now, with a couple of months of new data, the model has already reflected its predictive accuracy. The upper curve that we put in for Delta is more pessimistic than ones which can be found elsewhere, but the lower bound is about where most other forward-looking models are now to be found. Major models were showing U.S. fatality totals to reach or exceed 750,000 by December 1st. That's virtually guaranteed to happen, and we project that number to be closer to 800,000, as we said before. This would represent a doubling of the number of fatalities here just since mid-January, a period of only 10.5 months. We also, however, continue to hope for more continuing domestic acceptance of the vaccines, with some more rapidly expanding public implementation based on new pleas, incentives, and mandates directed towards those still holding out. Without the vaccines, U.S. fatalities would have exceeded 900,000 by mid-2021, based upon our being above this curve in the first quarter. So nearly 300,000 lives were saved in a matter of a few months. Those benefits could and should continue to accrue from both health and economic perspectives. As the unwelcome turn of events caused by the Delta variant unfolded, it returned us to a pretty unpleasant picture within just a month or two. Now, also, if you want to look at that chart again, the actual number right now of fatalities versus the unstoppable curve that was based on infection progression without vaccines. Vaccines have saved over 900,000 lives at this point. So you just look at the main curve and look at the actual figures, which we update monthly, and you can see that delta. So the effect of the vaccines has been quite significant. And yes, the USA is still atop the total case and total fatality lists for the world. We performed our own analysis of the 20 countries with the worst overall states of public health, and the USA fatality rate would put us in 4th position from the top of that list, even though we are not a member of the list of the 20 worst health countries. So we'll leave you to draw your own conclusion as to how well we did compared to countries with absolutely horrible public health. Now, as optimists, we are seeing the light at the end of the tunnel finally. We will have to get through the winter season to know for certain and to see a new flattening of the current red fatality line within our chart. There's additional data, again, from the COVID-19 health data source, and the link is provided in our written report. The current employment picture. In October, unemployment levels moved down to a national level of 4.6%. However, there are still 7.4 million remaining unemployed persons, many now without the lifeline of extended unemployment benefits. This level is about double of what a full employment situation would be, in spite of the low percentage of unemployed. Here's why. We have always been anticipating that return to work gains would flatten out below a full recovery level. These new numbers are consistent with our view that job gains would slow but still continue and may still take another 12 to 18 months to erase most of the remaining job losses created by the pandemic. That number is still estimated to be 4 million still jobless from the pre-pandemic levels. Now, a nominal level of 4% unemployment would be a target for the Federal Reserve to consider a gradual end to their highly accommodative interest rate and money supply policies beginning in mid to late 2022. As we expected, the new declines in unemployment below 5% have triggered a change in Federal Reserve rhetoric, signaling that we should expect to see a scripted tapering off of their current accommodative policies and then the associated near zero short-term interest rates. This was clearly stated in the FOMC, which is the Federal Open Market Committee statement, following their November 2nd and 3rd meeting. If inflation should flare up further, the Fed may move to end accommodation more rapidly. However, a large number of people have removed themselves from the search for work, so the new jobs figures amplify a decline in unemployment and are reflected in the October 4.6% figure. For example, the labor force participation rate has declined by 1.7% since February of 2020, just before the pandemic took hold. This represents an active labor force decline of 2.7 million people, some of which are due to a net balance of retirements and the rest mostly due to the consequences of the pandemic. If the size of the active labor force had stayed constant, the effective unemployment rate right now would be much higher at 5.8%. Expectations for continuing improvement in employment and the labor force participation rate are still predicated on the assumption that the National Infrastructure Package will assist in this with at least $120 billion per year, stimulating project-related employment. And then also included, we have a chart from the U.S. Bureau of Labor Statistics, which has been a common feature in our reports, so you can take a look at that in the written version. In the equities markets, in the first few days of October, equities market prices showed a continuation of the September correction, but then have since powered ahead several percent, setting new index records and again pushing deeper into bubble territory. S&P 500 earnings for the third quarter of 21 exceed estimates for 80% or more of the companies in that index. Third quarter 21 earnings reports so far have shown year-over-year third quarter earnings for the S&P 500 up well over 40%, which is very strong given the circumstances, but it is hardly anywhere near the amount that justifies the continuing leaps in equities prices over that same one-year period. There are similar year-over-year growth expectations for fourth quarter 2021 due to comparisons against a depressed fourth quarter of 2020. However, the market should be looking 6 to 12 months ahead, and the estimates for S&P 500 earnings and revenue growth are very slight in low single-digit percentages. There may be more pleasant surprises showing up later in the second half of 2022, but businesses currently face uphill challenges from supply chain restraints, higher energy costs, and higher labor costs, as well as shortages. These are the realities which should be exposed during earnings calls from the remainder of companies yet to report their third quarter earnings and outlooks for 2022. We'll be able to provide more details in our December report and January as well, as these earnings outlooks are digested and consolidated by analysts. The only 2022 earnings estimate for the S&P 500 that we have found so far shows a paltry 2% earnings growth to $206 for the entire index. Investors clearly haven't gotten this message yet in light of the continuing run-up in S&P 500 stock prices. In the past year, markets have only taken one short-lived break along the way to nosebleed territory from the record lows set in 2020. But a return to warm market levels would take the S&P down to about 3,500, and a correction to the mean would be near 2,800. We are still due for such a correction, but something will need to trigger it. The Fed's recent scripting of their program will only make the markets more confident, and something else will have to come along to rattle the confidence of market speculators. So instead, it wouldn't be out of the question to see the S&P 500 penetrate the 5,000 level by the end of 2021. How long it will last there is just a guess at this time. We monitor margin borrowing heavily as one of our tools for indicating speculative excesses in the equities markets. Heavy margin borrowing that is synchronizing with markets making significant new highs is a likely strong leading symptom for a market correction. In August, margin borrowing went back up a full 8%, back to a new all-time high. This was part of the rocket fuel mix that set the new index records that month. The latest information on margin debt is from September of this year, when the markets were still within their recent shallow correction. Near the end of that correction, margin borrowing had only declined a bit by less than 1%. So it still remains at historically high levels. We repeat our warning projection here now. History suggested that equities would tend to correct 10 to 12 months after the resumption of GDP growth, i.e. when a recession ends. Those months are the time period when corporate earnings roar back, then flatten out to normal. That suggested a potential window for a correction in the September to November 21 timeframe based upon our November 2020 announcement that Recession 2020 had ended. September and early October's correction has already met this criteria, but the correction was shallow, and the recent Fed tapering script will keep throwing fuel on the equities fire for now. Something else must serve as a trigger for a deeper correction if it is to happen. Watch for weak 2022 earnings projections, which is now likely to take over any other concerns for the markets. Now for our other AP individual indicator information. Our AP chart illustrating what is more widely considered to be the Buffett indicator has been updated again. We show several growth rate curves with the uppermost smooth curve delineating the boundary between a warm market and a hot bubble zone. We are now even deeper in bubble territory above that uppermost smooth growth curve. Our return to the mean is the center blue curve, and a return to the historical regression would reach deeply down to the second lowest curve. That regression history is based upon S&P 500 prices over many more decades than we feel are relevant to the modern market analysis. October's record closing value for the S&P 500 keeps our APSI indication as red, with that index still deeply in blatantly overheated territory. One primary indication of the top-heavy nature in equities is the ongoing spread between the S&P 500 and our metric representing the GDP. This gap narrowed a bit, trivial bit in September, but regrew in October with the new highs. We still see this as an indication that more of our money supply is still being directed towards speculative financial activities rather than into solidly productive activities, i.e. goods and services. An article published last month stated that there is now $1 to $2 trillion in value, we use that term euphemistically, value found in cryptocurrencies, which still qualify as nothing more than pure speculation in essentially nothing. We also include a chart which is courtesy of Advisor Perspectives, and the source is an author, Jill Mislinski. Her chart continues to shout out how risky the U.S. equities markets are using a set of 4 different market indicators, still very similar to our own in philosophy. The risk indicator average was 186% 2 months ago, at 181% last month, and now sits at 180%, down a trivial 1% from the beginning of September. So the speculative risks in equities continues at all-time highs. Here's the status of our other indicators. The APMS money supply indicator remains solidly green as the Fed continues their expansion of the money supply, having reached an estimated $20.78 trillion, up 7% since the beginning of 2021. The rescue and recovery stimuli clearly added further to the money supply, earlier in the year, and this was reflected in the final M2 numbers from the second quarter. Official third quarter figures for the M2 and the velocity of money were released in late October. Our internal projection for the velocity of money was a drop to 1.115, which was the exact number reported by the Fed. The money supply grew to just under 21 trillion. It is clear to us that the velocity of money has been reduced by real spending curtailments and a significant diversion of funds into less tangible speculative pursuits. Gold prices recovered in October to just above $17.90 at the end of the month. Silver followed suit, recovering $2 back to the $23.50 range. Rhodium had a relatively placid trading month, ending near $13,000 per ounce. Platinum spent the month trading between $1,000 and $1,060 per ounce. Month-end prices for gold and rhodium keep our AP/PM indicator deeply into the red, but the ratio is finally declining per our long-term expectations. The September leading economic indicators from the Conference Board and the Federal Reserve improved modestly, pushing our APLI indicator a bit further into green territory. We continue to expect slight but noisy improvements to these LEIs during the next few months. The Conference Board maintained their improved outlook for economic recovery and that we should expect a more robust recovery well into 2022. So our LEI indicator will likely stay solidly in green territory for many months. All of this is, however, predicated upon the absence of any overwhelming equity market correction or an unexpected worsening of unemployment during the upcoming months. Our APYC yield curve indicator continues green, now continuously for 6 months. The yield curve continues to move all on its own, maintaining a more normal shape with the short end firmly anchored near 0%, but with the 5-year up 20 basis points and the long end moving up 7 basis points by the end of October. With the stated changes in Fed policy, we should see additional dynamics in the yield curve in the coming months. The APFD Fed indicator returned to green 3 months ago with the belated NBER and Federal Reserve official recognition of the end of Recession 2020, a full 15 months after the date they claim it ended. Underlying financial system stability indices calculated by the Fed currently support this green status as well. The FOMC has now clearly stated they have the opposite expectations, as their November meeting report included a highly scripted tapering program through mid-2022, pointing towards declining asset purchases and then minor interest rate boosts in 2022. If inflation pops up harder or longer than they expect, or if a further expansion of the large speculative bubbles become worrisome, the Fed may be forced to react, raising short-term rates, which would likely collapse the equity bubble, if it has not already done so under its own weight and imbalance, which is now the less likely scenario right now. Should the economy weaken significantly, the Fed still has little left that it could do with short-term rates to further stimulate the economy if it becomes necessary. Greater asset purchases are its only remaining tool and would reignite huge increases in the money supply and the Fed's balance sheet. So they are treading very carefully along their path towards normalcy. Now that it appears we are going to be able to emerge from the pandemic tunnel and expectations are now more optimistic again, as reflected in more relaxed travel regulations, market and investor anticipations of the ongoing return to normalcy may continue for many more months now, but increased dynamics and volatility should still be expected, especially if Delta does not continue to rapidly decline. So in summary, Recession 2020 came and went over a year ago. Our warning system clearly foretold of it in late 2019, but COVID gave it a rocket-boosted start. Massive federal intervention ended it early and subsequently fueled the last 16 months of rampant equity recovery and widespread speculation in non-tangible assets. 4 of our 6 recession indicators remain in green territory. Precious metals still show red, and the extremely risky equities markets also show red. We are moving into a period in which our standard 6 indicators can be relied upon again, but will continue to be augmented by a direct watch of public health statistics, unemployment figures, GDP, velocity of money, and financial stability indices for several more months. Those are inherently less reliable short-term indicators of recession potential than the 6 AP indicators. With a new tapering script by the Federal Reserve, we cautiously reduce our next recession potential to 25%, down from 30%. If equities or employment should unexpectedly plummet, that picture could change quickly. So, final note, we continue to maintain that this is an extremely risky equity and market environment with the potential for significant and protracted drops or even flash crash scenarios based upon the indicator extremes shown in our charts over the past several months. A correction of 25 to 35% before the end of 2021 is now only a remote possibility due to the Fed tapering script and passage of the infrastructure package. Still, only those with higher tolerances for risk and a time tolerance for protracted returns to break even should be speculating in the equities markets at these levels. Well, that's all we have for this month. We hope that you have a great first holiday season in Thanksgiving at the end of November, and we'll talk to you in some of our other newly added reports and our general economic report in early December. Thanks for listening.